I'm going to talk about dollar cost averaging, which is the best investment strategy to manage market volatility. You can't time the market, meaning you can't predict when stock prices will go up and when they will fall. It's tricky to try to wait for the stock prices to fall to get in at a good price because it's really hard to predict when the downturn or the upturn in the market will reverse course. And that's why there's the saying that time in the market beats timing the market. So what exactly is dollar cost averaging? Dollar cost averaging is the practice of buying into the market in smaller trades that are consistently made at regular intervals over a long period of time instead of buying your position in a large amount at once. So dollar cost averaging minimizes the risk of buying at the top of the market. A lot of people who dollar cost average invest a set amount once every couple of weeks, and brokerage companies like TD Ameritrade have an automatic purchase program that facilitates this. If you have a certain percentage of your paycheck going towards your 401k every week or every couple of weeks, then that is fantastic. You are already practicing dollar cost averaging. For those of you who might be new to investing, I think I'll make a video later on different brokerage firms such as Vanguard or Fidelity that you can open an account with. Anyway, we've come to the end of my video on investing. Bye.